Hello everyone and welcome. My name is Elliot Gu and this is the next issue of Deep Dive Investing. Today we're going to take a really detailed look at the outlook for the global economy and also the credit markets. And as we often do every quarter, we're joined today by our London-based contributor who's a fixed income and credit market specialist. He's going to be leading today's presentation and we very much hope you enjoy it.
Hi Elliot, hello everyone. It's good to be with you today. I appreciate your time on President's Day. A quick agenda of all the topics that we're going to be covering today. We're going to be looking at the macro picture for the United States and specifically leading indicators, looking at the length and sustainability of the continuing economic recovery. We're going to be looking at some specific cyclical sectors, namely housing and light vehicle sales. These are sectors that are sensitive to and drivers of economic growth in the U.S. economy. We're also going to be looking at employment costs, not because they're likely to become a macroeconomic issue, in other words, something that might disrupt the ongoing expansion in the United States, but more because they may well become a stock market issue. And finally, we're going to be looking at the fixed income market, the disconnect between the treasury market and the behavior of the stock market since Christmas Eve. And we're also going to be looking at credit spreads and what signals credit spreads may be giving out on the health of the economic expansion and indeed of the recovery in the stock market. So without any further delay, let's jump into this. We're going to start with the leading indicators and specifically the Institute for Supply Management's Purchasing Managers Index. We're looking at the manufacturing index on this screen. And what we see is that since roughly the middle of last year, we've had an almost monotonic decline in the readings for this index. Remember, a reading of 50 means that the manufacturing sector is neither expanding or contracting. Anything below 50 signifies a contraction around the corner, and anything above 50 signifies an expansion. Despite the decline that we've seen in the second half of 2018, we're still at 56.6, which clearly means that the expansion in the manufacturing sector is going to continue in the foreseeable future. An important thing to remember is that even by the standards of this rather slow economic expansion that we've had since the Great Recession, this is an above average reading. Ever since this index returned above 50 after the Great Recession, the average reading has been 54.6, and we're at 56.6. So we have some margin over which we are still above any average reading that we've had, entirely consistent with the continuation of the expansion in the United States. More importantly, though, the leading index of this leading index, as I like to call the new orders sub-index of the manufacturing PMI, has also gone through a good recovery. When the index declined, as we saw in the previous slide, the new orders sub-index came perilously close to the 50 threshold, but has since rebounded. So from 51.3 for December, we're back at 58.2 for January. And this is an important index to see recover because as stands to reason, if your new orders start declining and there is no arrest of that decline, then eventually your current production is going to be declining, and that's the very definition of a contraction in the manufacturing sector. So no such thing in the cards. We've seen the recovery from 51.3 to 58.2, which, as you can see, is clearly a level that's entirely consistent with the levels that we've seen for new orders throughout this economic expansion. Let's also take a look at the non-manufacturing PMI for a second. Manufacturing is the more cyclically driven component of the economy, but it's a small component of the economy, roughly between 10 and 15% of the whole of economic activity in the United States, whereas non-manufacturing is a much more significant part by a factor of 5, 6, 7 times compared to manufacturing. Again, what we see is that we are far above the threshold between expansion and contraction. The latest reading in January was 56.7, which again is above the average level that we've seen throughout this economic cycle, the average being 55.6. So the non-manufacturing sector is also giving out quite strong signals. Absolutely no reason to think that any kind of nasty surprises are around the corner. Finally, let's look at the composite PMI. This is compiled by a different group. This is not the Institute for Supply Management anymore. It's a company called Market. They conduct manufacturing, purchasing managers surveys, not just in the United States, but around the world. They're a private provider. And what we see is a full corroboration of what we are getting from the PMIs of that the Institute for Supply Management provides. The key differentiator here, Market does a manufacturing survey and a services survey, but quite helpfully they also provide a composite purchasing managers index, and this is what we're looking at here. So the composite index, which combines manufacturing and services, is at 54.4. Again, well inside the area that signifies an expansion for the US economy. So with that in mind, with the leading indicators showing these strong signals, we also look at the cyclical sectors of the US economy just to take the pulse on a couple of sectors, housing and light vehicle sales, that are quite sensitive to fluctuations in the business cycle and which are also drivers of the business cycle. For example, housing accounts for roughly 4% of economic activity in the US. So if, for whatever reason, housing activity were to halve, that would bring us perilously close to the threshold for recession. So it's always worth while looking at the state of affairs in the housing sector. Now, what happened in housing is that back in November 2017, new home sales peaked at 700,000 new home sales at the seasonally adjusted annual rate. And since then, similar to what we saw with the Purchasing Managers Index, we've had an almost monotonic decline that brought us back down to 562,000 new home sales in October of this year. So this was a fairly established declining trend that gave some reason for concern, not just to us, but it was something that was being discussed in several market circles and by the punditry at large. The other thing that happened was that we've had the US government shutdown. As you can see here, this is an index, this is a data release that's published by the US Census Bureau. And the Census Bureau stopped releasing data after the US government shutdown and throughout its duration. So we weren't able to have up-to-speed data on housing as a result of that. But when the shutdown ended, they released the numbers for November. And what we had was a big bounce that you can see it here, brought us back up to 657,000 units at an annual rate. And this reversed several months of decline, took us back to where we were in the spring of 2018. And effectively what this did, if we look at the longer term picture, is that it basically made sure that we stayed on track with a long recovery that was established back in 2011, you can see the very big decline that we had once the housing bubble burst and new home sales declined from more than 1.2 billion units. These were the peak numbers that we had during the latter stages of the housing bubble. Then we went through a very big decline that took us back down to roughly 300,000 units. And then we had a gradual recovery that didn't quite restore us back to where we were back in the mid-noughties, but it certainly was a recovery trend, which was threatened by that trend that we saw as the housing market, or at least new home sales, peaked in November 2017. So we're back on track. Moving on to another key component when it comes to assessing the health of the housing market is the affordability of homes. There's an index that's compiled by the National Association of Realtors. This is what you can see on your screen now. This is an index that is constructed so that if the index is giving out a reading of 100, that means that the family earning an average income has exactly the amount of income that it needs in order to buy the median priced home in the United States. By implication, the current reading of 146 for the fourth quarter of 2018 implies that the average family has 46% more income than it needs to buy the average home. Now, compared to the peak affordability of earlier in this decade, as you can see here back in 2012, 2013, the average family was earning 2 times the amount of income that it needed in order to buy the average priced home. Now, this was an exceptional time in housing history because at that time, not only were interest rates extremely low, but house prices had not recovered yet from the burst in the housing bubble. So those two factors conspired to create that fantastic opportunity for families to buy homes because, as I said, they were earning twice as much money as they needed to buy homes at that stage. But again, looking at the history, the historical context of this index, so looking back 3 decades, we can see that 46% more than the income that's actually required is a dream level of affordability. As you can see, back in the 90s, a period of time when house prices weren't exactly depressed, when we had substantially higher mortgage rates than today, housing affordability would peak at the current level. So we have every reason to believe that homes remain affordable and that families that wish to purchase homes, even if they recently deferred that decision, hoping to get slightly better mortgage rates, have every possibility of acquiring a home. And we believe that the recovery in the housing sector is quite likely to continue. Moving on to light vehicle sales, again, a cyclical component of the U.S. economy. Autos and parts account for about 2.5% of economic activity. It's a volatile sector of the economy. As you can see, we have lots of ups and downs in the number of light vehicles that are being sold at an annual rate in the U.S. economy. Similar to what happened in housing, the peak happened in late 2017. You can see here about 18 million new vehicles sold in September 2017, and a decline since to the current level of 16.6 million new cars sold. So again, something to talk about, something to examine. Something that's been talked about more recently. But again, when we look at the wider historical context, what we see is that the current level of new cars being sold is entirely consistent with periods of economic expansion, both in terms of the current business cycle, but also in terms of the previous business cycle. As you can see, 16 million cars was entirely consistent with a long period of economic expansion in the previous cycle. We've discussed before our view on light vehicle sales. We've talked about the heavy competition from the U.S. From the used car market. So we don't think that this is going to become a macro issue going forward. Moving on to employment costs. The reason why we're looking at employment costs is that we've seen a trend recently whereby analysts looking at the prospective earnings, the 2019 earnings for S&P 500 companies, have reduced the growth that they expect for earnings in the S&P 500 from 10% last November to 5% currently. But over the same period, they have not reduced the growth that they expect in revenue. That can mean several things. One of them could be that they're still quite optimistic about revenue growth, perhaps unjustifiably so, whereas they've become less optimistic about earnings. Another explanation, though, and one that one could do some research and find out whether that could be the case, is that they actually expect margins, the profit margins that S&P 500 companies have. And here there's been a lot of talk about how employment costs are rising, and that they are rising at a pace that is faster than inflation. And that could be a problem because inflation represents the prices that companies charge U.S. consumers. So it represents the rate at which they can recoup any increases that they face in their costs of production, of which employment is a significant component. So what we've done is we've looked at the two manifestations, two components of employment costs. The first one is average hourly earnings. In the slide that you have in front of you right now, this is represented by the orange line. The yellow line represents the producer price index. It is a price index that represents prices at the factory gate. It's both an input and it's an input cost and an output cost for U.S. businesses. And the gray line represents the consumer price index, which is purely an index of revenues for U.S. businesses. So what you want for employment costs, in this case average hourly earnings, so that they do not become a factor that's compressing margins, is that average hourly earnings are rising at the same pace. They're not deviating from the producer price index or the consumer price index. And as you can tell, recently these lines have been rising in tandem, except that over the last few months we've seen a small deviation in the paths of the lines that represent revenues for U.S. businesses versus the line that represents the employment cost. Now, this could turn out to be a fluke. This could prove to be short-lived, but it's definitely something that's worth following. We also looked at the employment cost index. This represents total employment costs, including benefits, because again, there's a lot of discussion about whether businesses are trying to prevent salaries and wages from rising, but they're offering certain enticements to attract workers to particular industries. And so we thought we'd look at the total employment cost index. Again, we're comparing it to the producer price index and the consumer price index. And you can see again that more recently there's been a slight deviation between the producer price index and the total employment costs. This could prove to be short-lived, in which case it will turn out to be a false alarm, but it's definitely something that we're going to keep monitoring, because if this trend carries on, it may well signal margin pressures for U.S. businesses or listed businesses, in which case it could well become a factor that becomes a drag on the performance of the stock market. So something to keep track of, but not something that we are particularly concerned about, at least for now. With that, we're going to move on to the fixed income market update. Looking at the 10-year yields, what we see is that they peaked in November of 2018 at 3.2%, and we've seen a steep decline since, which has taken us back roughly 2.7%. This reflects two things. First of all, the bearish turn that we've seen in the stock market, but also some concerns about continued growth in the U.S. economy on the part of some investors. And also more recently, a capitulation on the part of the Federal Reserve to a much more restrained outlook for the U.S. economy. We've had statements coming from the Federal Open Markets Committee, which has said that basically the rate hiking campaign is going to be put on hold for the time being. So naturally, there was a reaction in the Treasury market. But again, when we look at the latest move in the market with a longer term view on these things, what we see is that effectively the trend of rising Treasury yields is still intact, and that in fact the present position is by no means remarkable. We've had roughly the same level of Treasury yields back in 2014, 2015, and this is entirely consistent with a continuation of the recovery in the U.S. economy. Okay, so what brought us in this position in the first place? As we know, the Federal Reserve raised rates 4 times in 2018. The market at some point got uncomfortable with the trajectory of policy interest rates. We can see again the peak in 10-year yields around November of last year, and then there was a bearish expression on the part of many investors, which brought yields back down. Now, this meant that the yield curve that started out quite steep at 145 basis points, or 1.5%, back in the beginning of 2018 flattened. But it didn't become too dramatic in that the yield curve failed to invert. We are in a position now where the market feels that we've reached an equilibrium. This is exactly what the Federal Reserve itself has now signaled, that it believes that we are roughly at the neutral rate of policy rates, a rate which neither stimulates nor constitutes a drag on the U.S. economy. Again, looking at the entire trajectory for both policy rates and 10-year yields for the U.S. economy, what we see is that we've had a substantially steeper curve, almost 4% or 400 basis points back in 2010, and we've been on a path of normalization in terms of the policy rates since 2015. And it's been effectively the rise in policy rates from 0.25% to the current 2.5% that's brought the yield curve to the present position. The flatness of the yield curve means that there is confidence in the short run, because if we didn't have confidence in the short run, the market would go ahead and invert the yield curve. But there are also some doubts as to whether policy rates can go substantially higher, or whether the U.S. economy can expand substantially faster than the present level. From a stock market perspective, though, to the extent that there's no signal from the fixed income market that a recession is around the corner, then we're still on track with a continuation of the recovery in share prices and hopefully a new high in the not too distant future. This whole situation is reminiscent of what happened between 1994 and 1996, when the Federal Reserve raised rates quite aggressively within less than 12 months, as you can see here, from the early part of 1994 to the early part of 1995. It raised rates from 3 to 6%. The market at some point got concerned that the Fed had got carried away, so 10-year yields started dropping. The yield curve flattened out quite substantially. The Fed capitulated, and in fact it cut rates 3 times back to 5.25% before confidence was restored in the economic expansion, and then eventually yields started rising again. The rest is history, as we all know. The Federal Reserve, with some further fluctuations, raised rates up to a high of 6.5% in early 2000. So we could well see the Fed going on hold without derailing the recovery either in the economy or in the stock market itself, giving the economy and investors more time to regain their confidence before we start seeing a recovery in yields and potentially higher rates going forward. Last but not least, credit spreads. You can see here the spike that we had in credit spreads. This is investment grade credit spreads back to the average level that we've seen historically since 1997, since Merrill Lynch started compiling data for investment grade credit spreads. Spreads rose from roughly 90 basis points to 160 basis points, and then we've seen a recovery in credit markets in the form of declining spreads. And the same holds true of high yield spreads. We went back to roughly the average over the same period since 1997, close to the 560 basis points, which is that average, and we're now back down to 420 basis points. So again, a reflection of what happened in the stock market, about a risk aversion, of heightened concern about the prospects for investment for the risk sectors in the U.S. economy, and then a sharp recovery. I should also note that this represents spreads on cash bonds, which have been commanding a liquidity premium versus their counterparts in derivatives markets, where investors don't actually have to exchange the full cash flows that they need to require to exchange in order to acquire the bonds. So I think ultimately the picture that we're seeing here is slightly more bearish than the underlying tone that exists in credit markets. I think this is entirely consistent with the recovery that we've seen in the stock market, and it's certainly not something that gives us any reason for concern. It doesn't show any divergence between how investors in credit markets feel and how investors in stock markets feel. So that concludes our presentation today. Just to recoup on the points that we've made, we think that there is a very healthy macro picture for the U.S. economy. The economy is very, very likely to continue expanding. This is entirely consistent with rising share prices. There are some issues to be watching, specifically as they relate to corporate margins in the United States. This is something that we're going to continue to follow. We're not concerned at the moment, but we're looking at some areas of potential weakness. And then in terms of what's happening in the fixed income market, entirely consistent with a continuation of the expansion, entirely consistent with the continuation of the bull market in equities.